Welcome everyone to our retirement webinar this evening. My name is Owen Mead and I'm one of the retirement and investment managers here in Cornmarket. As you can see from the agenda, we have several informative presentations for you this evening. Our first presentation is by Emer, and Emer will look at your superannuation and how your pension is calculated. Pamela then will talk us through additional voluntary contributions, or AVCs as they're better known. Connor will cover the area of investment and how to make the most out of your money in retirement. Pamela, Connor and myself will then discuss some frequently asked questions that we receive on a daily basis from our clients. Last but not least, we have Cornmarket's Wellness Ambassador, Brent Pope, in to discuss his tips on approaching retirement and looking after your overall well-being. If you have any questions, please feel free to use the chat function in the webinar. Our experts are there in the background, only happy to answer any of your questions. For those of you retiring this year and have given us consent to contact you, we will be in touch for your free one-to-one retirement appointment. Now, let's pass you across to Emer for our first presentation.
Welcome everyone. My name is Emer Conroy and I'm one of the Life and Pensions Managers here in Cornmarket Group Financial Services for almost 10 years now. Today I am delighted to bring you an overview of superannuation and your retirement. Our retirement planners will typically meet you 2 to 3 times during this year that you plan to retire. This is to ensure that all of those plans that you have in place are put into action. We'll be with you every step of the way. So what is superannuation? This is a defined members' contribution scheme that you as public sector are members of. It is paid as deductions from your salary every week, fortnight or month. There are 3 key benefits as members of the superannuation scheme. The first is your lump sum, also known as your gratuity. A lot of you may have heard of this already and may even have some plans to spend. The second is your pension. This is your income in retirement, therefore it's taxed. However, it is guaranteed to pay you for the rest of your life. The third key benefit is your spouse and children's. This is a protection benefit and is there to give you peace of mind in the event of death. It is there to give you your family and your kids a form of financial security. So what do you need to know when you're thinking of retiring? The first is, what scheme are you a member of? Believe it or not, there are now 4 pension schemes in public sector. What years of service do you have? The third, what is your actual pensionable salary? And the fourth, will you get an old age pension? Typically, when we sit down with our clients, very few have a full 40-year service. This can be due to a variety of reasons. For example, have you job shared? Have you taken unpaid maternity leave? Or for example, you may have started work 40 years ago. However, you resigned from post and you re-entered back into public sector. This can mean that you could have split service and therefore split benefits. There are a few other scenarios that can affect your years of service. For example, carers leave. You may have had to take some time off to look after a sick relative. You may have actually had to take some unpaid sick leave yourself. This all counts towards your overall service history and therefore can affect your pension benefits. So how is your pensionable salary calculated? Well, we will take your annual salary at the date of retirement. We will then look back over the last 10 years prior to your retirement, and we will take the 3 best consecutive years within that. This is to calculate your average of your pensionable premia and allowances. To give you an example, if your basic annual salary is $50,000 at the date of retirement, we will look back, we will calculate it for you, and your pension emoluments could be up to €10,000. This will give you a final pensionable salary of €60,000. If we take a look at the 4 superannuation schemes within the public sector, all of them are different. Anyone that started before April 2004 will have a normal retirement age of the age of 60. For those members that started after April 2004, your normal retirement age will be 65. For the new entrants who started from the 1st of January 2013, you don't actually have a guaranteed normal retirement age. This is currently the age at which state old age pension is paid, currently 66. So let's take a look at how the pension calculations actually work within the superannuation scheme. We use a formula of 1/80th. We calculate all your years of service. We calculate your pensionable salary. When we look at Marie here, her pensionable salary is 60,000. 40 years of service means she has a pension of 30,000 euros guaranteed for the rest of Marie's life. If we take a look at how the lump sum is calculated, we use a formula of 3/80ths for every year of service, times your pensionable salary. Marie here is then going to have a 90,000 euros tax-free lump sum paid to her on retirement. So let's take an example of one of the clients that we would meet on a daily basis. This client is in Scheme 1, pre-April 1995. As I mentioned, their normal retirement age is 60. So Jean here would like to retire at the age of 60. Like a lot of our clients, she won't have 40 years service. She will have 30 years of service. Therefore, using the 3/80ths, Jean's lump sum is going to be 67,500 euros paid at retirement. However, had Jean had worked 40 years, this could have been 90,000 euros tax-free paid to Jean. If we look at Jean's pension, again, it's the 1/80th times her 30 years means Jean is going to receive an annual pension of 22,500 euros. Let's look at Scheme 2. This is for those members that joined after April 1995. They still have a normal retirement age of 60. However, John here would like to go with 30 years, like Marie. His lump sum is going to remain the same, 67,500 euros. But let's look at John's pension. John is going to actually receive the same as Marie, 22,500 euros. However, John's pension is going to come from two income sources. His pension from the employer is 12,800 euros a year. On top of that, he's going to receive a supplementary pension of 9,700 euros paid from the age of 60. So in total, it is the same as Marie, 22,500, but he will have two income sources. So what is the supplementary pension? Well, we have to be mindful that not all of the members in the 4 different schemes will receive this payment. Jean did not receive the payment because she started before April 1995. For those members who also joined from the 1st of January 2013, they will not receive the supplementary pension either. So the supplementary pension, what is it? It's an additional form of pension payment. It is only paid until you receive the state pension. So in John's example, he retired at his normal retirement age of the age of 60. The supplementary pension is there to bridge the gap between the age at which he retires and the age at which John receives state old age pension. So approximately 6 years. For John, as an example, he was used to receiving one income while he was working. As you can now see, there will be multiple income sources once you hit retirement. For example, your pension and your lump sum. You may have job seekers benefit, supplementary pension, and then the old age pension will be paid also from the age of 66. So who is entitled to the state old age pension? Very like the supplementary pension, not all of the scheme members are entitled to this payment. In this case, the pre-April 1995 will not receive the state old age pension. Anyone that started from April 1995 because of the A class of PRSI, you will all receive the state pension to form part of your pension payment. So what could you get? The state old age pension is currently just over 13,000 euros per year. So it's about 253 euros a week. Now, hopefully, we'll all be here until over the age of 80. This then increases by €10 a week. And it is currently paid, as I mentioned, from the age of 66. So let's look at Scheme 3. For any member that started from April 2004, your normal retirement age has now moved out to 65. This is different to the first two schemes that we've spoken about, where their normal retirement age was 60. For the post-January 2013 single scheme, you no longer have a normal retirement age. It's currently the age of 66, which is state old age pension. Now, the good news is all of you can still retire earlier than these normal retirement age, which is great news. You can actually retire up to 11 years earlier. So how do you do this? This is called cost-neutral early retirement. So it allows you to retire earlier than your normal retirement age, which is 60 or 65 or state old age pension. However, they do apply a reduction in your superannuation benefits. So up to 11 years earlier, wouldn't that be great? So how does it work? Well, depending on when you'd like to retire, and depending on how far away from your normal retirement age that is, the actuarial reductions are applied to both your lump sum and your pension. But it does give you options. So let's look at Paul. Paul is really looking forward to retiring at the age of 53. He probably has plans, like we all do, maybe a round the world trip, or maybe he just wants to relax. So Paul has a salary here of €60,000, 30 years of service, and he's in the pre-April 1995 scheme. So Paul retires at the age of 53. His normal pension should have been $22,500. However, Paul really wants to retire, so he's okay to accept a cost-neutral reduction down to 71%. This means that Paul is actually able to go, at the age of 53, on a pension of just under €16,000 a year. But he could potentially have a retirement of $16,000 of an income for maybe 30 years. He will also still receive his lump sum. His lump sum should have been €67,500. The cost-neutral actuarial reduction is 87.2%, which means Paul is still going to get a lump sum with 30 years of service of just under $59,000 tax-free in his hand to enjoy. So let's look at the third benefit of superannuation. This is your spouse and children's benefit and can be paid in two ways. It's there to protect your family financially in the event of death. So it's really there to put your mind at ease. The first payment is called a death and service benefit. This is a lump sum paid between 1 and 1.5 times your final pensionable salary, and it's paid out to your family or your estate. The second payment comes in a form of income. So this is where your spouse will receive half of what your pension should have been, again for the rest of their life. If you have any dependent children, up to a maximum of 3, they will receive half of that third of your spouse's pension, again paid until the age of 16 or potentially 22 if they're in full-time education. So that finishes our presentation. I really hope that you found it of some benefit, and we hope to see you again soon. Thank you.
Hi everyone, my name is Pamela Keelan and I'm one of the retirement consultants here in Cornmarket. And my role is to help retirees like you to plan for and to understand your retirement. So today I'm going to look at additional voluntary contributions, or as they're better known, AVCs. So first of all, we'll have a look at, well, what is an AVC? Then we'll have a little chat about the tax relief and how all of that works. And now as you're nearing retirement, you're going to want to know, how do you access your fund? How do you draw down that money? And how do you get the value for that money that you've been putting away over the last number of years? And lastly, towards the end of the presentation, we'll have a look at lump sum AVCs and maybe is this something that you should consider prior to your retirement? So additional voluntary contributions, or AVCs as they're better known. So what is an AVC? So an AVC, simply put, is a savings plan. A savings plan that you contribute to while you're working to have down along the road when maybe your income isn't as good and you've built up this extra pot of savings in the background. So why then might you consider taking out an AVC? So there's a number of different reasons. So one is if you plan on early retirement. So if it's a case you want to retire early, you may have reduced pension benefits. So obviously if you have an AVC, that can help. The second thing is a shortfall in service. So if you're retiring and you don't have the full 40 years, again an AVC can help make up that shortfall in your tax-free lump sum. The third point there is if you have over 40 years of service. And this is probably something that not a lot of people are aware of. So there's a little rule in the background of revenue. So there's kind of two rules to be conscious of. One is your employer rules and the other is revenue rules. So the revenue rules will state that if you have over 40 years of service and you're over the age of 60, that you can contribute 3/80 of your salary for every year over 40 and over 60 into an AVC that you can then take back tax-free. So all I would say to anyone watching today is, if you're going to fall into this category where you are going to have over 40 years of service and you're over the age of 60, just jot it down, come back to us and we'll obviously go through this in more detail. The fourth point there relates to non-pensionable earnings, and this is one that we come across quite often. So this could be in relation to overtime, it could be exam correction, or it could be supervision. So it's basically a salary or money that you've earned, but it's not counted for pension purposes. The fifth thing, again, kind of relates to these two rules I spoke about a second ago. So the revenue maximum pension. So within the public sector, you can fund for half of your pension, for half of your salary, as a pension. And the private sector, it's 2/3. So sometimes we might have people who are trying to strive to get to that 2/3 revenue max. And the last point then is to make the most of tax relief, which I'll explain here now in a second. So you've often heard about AVCs and the great tax relief that goes along with it, but you mightn't necessarily be sure exactly how that works. So if you just take a moment and if you just picture your payslip for a second. So on the top right-hand corner, you'll have all your deductions. You have your tax or your PAYE, you'll have your USC and you'll have your PRSI. And on the bottom right-hand corner, you have your net take-home pay. So for every €100 that goes into an AVC, and again assuming you're paying the higher rate of tax, basically what happened is €40 is coming from your PAYE or your tax, and then €60 is coming from your net pay. And what's happening then is the 40 and the 60 are combining together, and that's making the €100 that's going into your AVC. So the tax relief is really, really good. In fact, it's so good that what happened was revenue had to put limits in place, okay? And the limits then will kind of tied in with your age. So if we go look down the bottom for a moment. So if it's the case that you're retiring and you're age 60 plus, revenue will allow you to contribute 40% of your salary towards a pension. Now, this never really becomes much of an issue because while 40% is a really nice figure, sometimes it's not achievable. I suppose people can't afford to put away 40% of their salary. But it's just more to know that there are limits in place. So on the next slide here, we just take a look. So last year, in 2021, we had almost 1,200 Cornmarket clients that would have settled an AVC. Okay, so the total combined value of the AVCs was 80 million. That's a massive amount of money. The average AVC was 67,000. And from that, the average tax-free lump sum payout was €18,000. So let's take a look for how this works in reality. So we have Mary. Mary's retiring. She's on a salary of 60,000 and she has 32 years of service. Okay? So based on her 60,000 salary, the max that Mary can get tax-free is 90,000. So it's 1.5 times her final salary. However, Mary doesn't have full service, she only has 32 years. So based on her 60,000 and her 32 years of service, she's actually going to get paid 72,000 from her employer tax-free. So if we look here then, the difference between the max she can get, which is the 90, and the 72 that she's actually getting, the difference between the both is 18,000. So first and foremost, what we're going to advise Mary to do is to take that 18,000 out of her out of her AVC completely tax-free. Also, if you remember back kind of at the beginning, I kind of stated that, you may have non-pensionable earnings. You may fall into this 40-60 rule. So again, if any of these apply, we'll obviously factor all this in when it comes to the calculation of how much you can take out of your AVC tax-free, okay? But the golden rule here is you always take as much as you can tax-free out of the AVC. So if you think about this for a second, Mary's retiring with 32 years of service. She's going 8 years earlier, but with the exact same tax-free lump sum as she would have received had she'd worked the full 40 years. And that's obviously with thanks to her AVC. So now we know that there's an element you can take out tax-free. What happens to the remaining money in the pot? So there's a few different options here. So one, you can purchase employer benefits. The second one is an annuity or an income for life. The third one, and probably the one you may have heard of most often, is an approved retirement fund, or this ARF. The fourth option is you can take it as taxable cash, or the fifth one is a combination of all. So let's look at these in a little bit more detail. So the first option here is to purchase employer benefits. So to begin, I'm just going to split this up into two. So the first thing is your notional service purchase. So this is where you're going to your employer and you're buying back 1 year of notional service. This is a year that you haven't worked. So what will happen then is your employer will then give you the costing to buy back that 1 year. Now, my experience, and especially if you're doing this and you're very close to retirement, is that NSPs can work out to be quite expensive. However, if this is something you want to explore, by all means, go and get the costing from your employer, and then you can make a decision whether this is right for you to do. The second side of this is buying back years of service that you worked, but for whatever reason, you weren't included in the pension scheme. And this will usually back maybe sometimes at the beginning of your career. So you might work for 2 or 3 years, you're getting paid a salary, but you're not included in the pension scheme. So when you're buying back years of service, you have two options on how you pay for this. So one is that you use your tax-free lump sum, okay? And the second option is you take it as a lump sum out of your AVC. So again, in the majority of cases, people will use their tax-free lump sum. And the reason being is that you can then claim the tax relief back on the deduction from your lump sum, okay? So if we think about this logically, if you go down the AVC route, well, when you were paying into the AVC, you wouldn't be getting tax relief. So revenue naturally aren't going to allow you to claim tax relief a second time. So if you take the lump sum or if you take the payment out of the AVC, you can't claim the tax relief a second time. So you're basically wasting tax relief. But again, if you're unsure about this, come to us and we'll help you in making a decision as to which option is best for you. Okay, so the second option then is an annuity, or what's known as an income for life. So this is where you're giving an insurance company the 82,000 balance in this example, and they are then paying you an income for life. So if we go back maybe 15, 20 years ago, this would have been a popular option. However, now, not so much. So if you think about, and I'm probably being a little bit generous here in this example, but annuity rates at the moment, even if we take an annuity rate of 2%, what that means is you're giving the insurance company over the 82,000, they're paying you 2%. So you have to live for 50 years in retirement to get back your money, okay? The third thing to note here is, if you retired this year, and God forbid you pass away next year, well, guess what? The 82,000 is gone with you. So for that reason, annuities, I suppose, aren't as popular at this moment in time. The third option then, and probably the one you hear of most commonly or more often, is an approved retirement fund, or this ARF. So this is where the balance of the AVC transfers into an ARF. And basically what happens then is you draw down from that pot of savings throughout your retirement. So you could decide you want to take €1,000 per year, you could decide to take €2,000 per year, you could decide to take €10,000 per year. It's entirely up to you. Now, one thing to note is withdrawals are treated as income, so they are subject to income tax. There's another little rule in the background that from the age of 61, there's a minimum of 4% that you must take every year, and from the age of 71, that increases to 5% every year. So as I said, the money goes into an ARF and it's invested. Okay, so there's a number of different investment options. So you could be a very cautious person looking for something very, very low risk. I said we have different options going right up to the high risk. However, my experience with dealing with retirees is usually you fall somewhere in the middle in that low to medium risk category. But you want to put your money somewhere where it's going to get a decent return. And last thing to note on the ARF. So again, if you retire this year, and God forbid you pass away next year, well, the difference here is the money does not die with you. So what will happen is the balance of the ARF is paid out to your next of kin, or it's paid out to your estate. The fourth option then is you can take it as taxable cash. So in this scenario, obviously 82,000, that wouldn't be advisable, because by the time you pay the tax in USC, well, you'll probably be lucky to come out with just over the 40-odd thousand. Now, that being said, I suppose if you take an AVC value of 20,000, and in the example of Mary that we had earlier, so if she's taken 18,000 out of her AVC tax-free and there's a 2,000 euro balance, then fine, she may decide just to pay the tax USC and just close off the AVC. So the last option then is where you do a combination of all. So this may be where you decide to use some of the money to purchase employer benefits, and then the balance you may invest in an ARF. Okay, so if we take a breather then for a second, because up on this point, we've kind of concentrated on those of you who have AVCs. We've spoken about how much can you take out tax-free and what the options are for the remaining balance. But what if you're watching today and you don't have an AVC? Well then, is a lump sum AVC something that you should consider? So let's look and see, well, what is a lump sum AVC to begin with? So this lump sum AVC, or last minute AVC that's sometimes referred to, is basically a single premium contribution you make prior to retirement, and the sole purpose is to make up the shortfall in your tax-free lump sum. So I think the easiest way to show this is through an example. So we'll take John, who's obviously coming to retirement. He's met with one of our Cornmarket consultants, and basically what has been decided is that John is going to put 15,000 into his AVC. Okay, so he puts in the 15,000, he then goes to revenue and he completes a tax return. And assuming he's on the higher rate of tax, 40%, he's then claiming back 40% of the 15,000. So John is going to get back 6,000 euro in tax relief. He then comes to retirement and he gets a 14,000 back out of his AVC. The difference is just of the €1,000 is just obviously the fees and charges. So there are fees and charges for setting up an AVC. But in this example, he's a 14,000 back from his AVC. He's a 6,000 back from revenue. So he's a combined total of 20,000, but he's only ever invested 15. So there's €5,000 profit, and that's solely down to the tax relief. So why would you do a last minute AVC? So there's a number of reasons. So again, we've kind of covered some of these earlier in the presentation, but if you've less than full service, okay, so if you don't have the full 40 years of service. The second one is that rule I touched on earlier again, this 40-60 rule. So if you have over 40 years of service and you're over the age of 60, you may need to contact us, because an AVC may be something that we can do, and obviously you can then benefit from the tax relief. If you've non-pensionable earnings, again, which is the overtime, exam correction, supervisions. And the last point there is if you've experienced a reduction in pay. So to kind of keep this point simple, so again, it goes back to the two rules. So when your employer is obviously paying you your benefits, your pension, your lump sum, it's based on your final salary. However, revenue aren't concerned about your final salary, because what they will allow you to do is they will allow you to look back over the last 10-year period. So if you feel that your salary was greater at any stage throughout the last 10 years, okay, then we may be able to help you with a last minute AVC. So how do you go about setting up a lump sum AVC? So again, what will happen is you'll meet with one of our core market experts before you retire. You'll see there that it says it takes about 6 to 8 weeks to set up a last minute AVC. So I would encourage people, don't leave it till it's 6 weeks before your retirement. Normally, people will kind of know they're going to retire, whether it be 3 months or 6 months out from retirement. So just let us know as soon as you can. We'll then obviously calculate what you can do based on your service, your age, and your own tax situation, okay? And if it's a case that you shouldn't be doing an AVC, so why shouldn't you do a last minute AVC? Well, if it's a case that the cost of the AVC outweighs the benefits, then guess what? We'll tell you that it's not for you. So before I kind of wrap up, there's one last thing I just want to touch on here, which is retired members' life cover. So for anyone who has salary protection, you're probably aware there's a certain element of life cover automatically built into your salary protection. But now that you're nearing retirement, your salary protection is going to stop. However, if it's a case that you'd like to continue on with a certain element of that life cover in retirement, then what I would advise is to look at this retired members' life cover. And the good news is, if you're already in your salary protection, there's a preferential form that you complete, which means you don't have to answer any of the medical questions. If it's a case you don't have salary protection, you can still avail of this life cover. The only difference is you will have to go down and fill out the longer form and complete the medical questions. Okay? So, again, if you think about it, we've covered a lot today, and we've looked at the ABCs, the lump sum, what you can do with the remaining balance, and we've also covered off the last minute or the lump sum ABC. Okay? So there's a lot to take in here. So, as is often said, like, you only retire once. So let's be honest, you want to get this right, okay? But Cornmarket, we have our own retirement team. We're there to help and guide you as much as we can. Okay, so I just want to take this opportunity just to thank you all for joining me today, and just to wish each and every one of you a very happy, healthy, and a really enjoyable retirement. Thank you.
Hello, there's a seanchal many of you will be familiar with. It's fearan sláinte ná an táinte. Health is better than wealth. In the recent past, we've seen indeed how true this is. What the recent past has always also shown us is, in life, there are knowns and there are unknowns. There's a famous phrase from a famous general whose name I can't actually pronounce, but he stated that no plan survives first contact with the enemy. But that's exactly what a good plan does. A financial plan has brought you to this stage of life. You may have saved the children's allowance towards third level education for your children. You would have protected your salary in relation to your income and your dependents. You would also potentially have made sure your mortgage was paid off in your mid to late 50s. This is all financial planning, and the financial planning will continue into retirement. You'll have a retirement financial plan. But the things that you need to be conscious of change somewhat for your financial planning into retirement. Retirement used to be thought of as the destination, whereas now it's very much a process of change. And there's 3 key areas that we're going to focus in on here today. So the first topic we're going to focus on is falling or indeed non-existent interest rates. You used to put your money on deposit with the bank, credit union, or indeed the post office, and you'd get a rate of return on that money. If you go back to 2011 with the post office, you could put your money into the 5-year certs and bonds and you'd get a return of 3.5% a year, and that was tax-free. It was excellent. The equivalent rate of return now on that 5-year cert or bond is 0.59%. Credit unions, many of you will have credit union accounts. Local credit unions are capping the balances in accounts. The reason being, they'd have to put that money on deposit with a financial institution once they have lent some money out. That institution then has to put the money on deposit with the European Central Bank. And the European Central Bank, the ECB, it's charging negative interest rates. So basically they're charging the institution for putting that money on deposit. So it's a policy of the ECB to keep money pushed back out into the economy in order to create economic growth. Now, falling interest rates wouldn't be an issue in and of itself if it wasn't for a topic called inflation. We're very familiar in the current environment with inflation. Inflation is the way money loses value over time. Now, how you spend your money in retirement is very different to how you may spend your money earlier on in life. The rate of inflation is very different for a 20-year-old or a 70-year-old. So as you can see here, you tend to spend more of your money on the higher inflation goods, the likes of your energy costs, your insurances, etc. This is just a brain teaser just to reflect on inflation. So what do these have in common? Well, aside from the fact that I'm a little bit too fond of all of them, there's one word, and it's shrinkflation. So inflation and shrinkflation are two sides of the same coin. Money loses value over time. There was a controversy there a couple of years ago, you may remember, where they made the gaps in the Toblerone bigger. Now, thankfully, they have reversed course on that. But again, it's just another example of shrinkflation in action. Now, have a think about a particular area of your finances where both shrinkflation and inflation have been particularly relevant. Health insurance. Going back 25 years ago, the majority of nearly everybody had VHI and a particular plan. But now there's 330 plans on the market across a number of different providers. But the cost has risen exponentially over that time. But also what we're covered for has reduced. We're going a little bit like our friends in America now with co-payments and shortfalls, like an orthopedic procedure, for example, you may have to contribute €2,000 towards the cost. So that's the effect of, on the one hand, inflation in terms of the cost, but also shrinkflation in terms of what you're actually getting for your money. You think back to 2001 when we joined the euro. When you had a £20 note in your hand, you felt like you had real money. Now, if yourself and a friend go out for lunch with €50, what change do you get? So again, that's the effect over time of money losing value. You can see here, if you were to put €100,000 under the mattress, let's say, as time goes by, because of inflation, the real purchasing power of that money will reduce. The value of your money goes down over time, and ultimately the cost of living is going up. So you take that money back out after 15 years, it's still €100,000, but it'll buy you what €48,000 would have bought you today. So that's the effect of inflation. And inflation then feeds into the third area that we're going to focus on. So will you have enough money for the retirement that you want? You need to look at longevity. It's human nature to think of the first couple of years in retirement. But the reality now is somebody retiring today, the life expectancy will be 20 to 25 years. We had a baby boy there born, he was three years ago, he's 3 now, and I looked at it at the time. His life expectancy is 104. He can reasonably expect to live to 104. The first person to live to 150 has been born. So we're living longer. Therefore, we're not talking about the first 5 or 10 years in retirement, we're talking about 20 to 30 years plus. So the longevity element then is a particular area to be conscious of when you look at how you actually spend your money in retirement. So spending in retirement is V-shaped. In the initial stages of your retirement, you'll travel, you'll have the social life, you'll go and visit your daughter in Australia, you'll go out for lunch regularly with colleagues and friends, you'll go away for occasional weekends, you're more active, and you may also have some debt, mortgage or personal loan that you may pay off. So you tend to spend more of your money, a substantial chunk, and it's higher at the start of your retirement. Then as time goes on, that's less of a factor. You don't spend as much money, you might spend more time at home, the mortgage is paid. But look here at the back end of the V. So the longer you live, and at the back end of the V, the more money you need for your retirement and the more costly ultimately that it's going to be. So that's really where the effect of inflation takes into account when you're planning for 20 to 30 years in retirement. So as I said, there are knowns and there are unknowns when it comes to your finances in retirement. And we're now advising public and civil servants for 50 years in relation to their finances up to and at retirement. So we know what tends to happen. You'll get your lump sum from your pension scheme, but then you might do a bit of work around the house. It was put on the Mayor Fada over the last few years. You'll have the holiday. You might, for the first time, buy a car outright rather than borrowing to buy a car. So these are all the things we know that happen. But you also have to plan then for the unknowns. So you have healthcare, ill health potentially, you have to plan for potentially inheritance costs and really family costs as well, because many people when they retire, especially if you have children, you might give a few pounds to your daughter who's getting married in a couple of years or a son who's buying a house potentially, you might give them some money towards the deposit. So you have the knowns and you also have the unknowns as well. So that then is how you structure your retirement financial plan, factoring both into the equation. So the start of your retirement financial plan you have your emergency cash. So that's the money that you have sitting there. If there's an issue with the car, you need to change the fridge for some reason, you have the money there in the short term. And that's the start of your plan. But from there, what should your money look like in retirement? It should look like this, a triangle. So you have your short term, your medium term, and your long term money. So the short term, you keep money in your current account, you keep money in the credit union or the post office, and that's to meet any short-term costs that may arise. Really anything then past 5 years, you need to ensure that you're getting a rate of return on your money in order to keep pace with or indeed outpace inflation. So when you structure it like this, if you take, for example, €100,000 and you're getting 0.5% of a return on your money, but inflation will be very conservative and say 3%. So in real terms every year, you're losing 2.5%, which on €100,000 is 2,500. So for your short-term money, you have to take the effect of inflation, but really over 10 years, that would be €25,000. So that's how much your money will lose over a 10-year period by it not growing in line with inflation. So on the long term then, your medium to long term money, when you're looking long term, as I say, you do need to get an element of return on your money for it to keep pace with or outpace inflation. So you're looking at investing in assets ultimately, because assets over time will grow in terms of their value in line with inflation. So what do you need to be conscious of when it comes to investing your money for the medium to long term? Well, there's a few key areas. The first one is understanding risk and volatility. You also then need to diversify when it comes to your money, and also choose carefully, particularly in terms of the provider, both in terms of the advice, but also the financial institution where you're putting your money. So let's talk firstly about risk and volatility. So when it comes to an investment, everybody can be put on a scale of 1 to 7. Now, as we said, there is no such thing as no risk, because inflation is a risk in and of itself. But on this scale, someone will be more risk averse when it comes to how their money is invested, so they would be on the lower end of the scale, and someone then who would be more open and understanding of the need to invest to grow your money would be a 5 or 6. Me personally, I'm a 6 on this scale. If I did this exercise with 100 retiring public and civil servants, what do you think the number would be on average? It'd be a 3. So we do this exercise to identify your attitude to risk and return. We create your risk profile, and then ultimately we'll advise investments to match. But most of our retirement clients like cautious investments. So they understand the need to get a rated return on money, particularly in the current inflation environment, but also then they don't particularly like volatility in terms of the value of the fund over time. So we have to be conscious of that when we actually provide the financial advice. This is a really interesting slide to look at, and it's really a great way to understand how an investment over time should work and the reality of how it works. So we've had, if you go back over the last 20 years, we've had a number, I suppose, of what you'd call 1 in 100-year events. And that has created volatility in terms of asset markets over time. And you can see here the economic cycles. But the long-term performance, the long-term graph of a multi-asset or a managed fund over time is in an upward direction. But you can see in the short term, there is volatility at different stages. So you can't time this. It's about timing it's about time in the market rather than timing the market itself. You then need to consider diversification. So you need to diversify your money, okay? So immediately you're diversifying your money by keeping some money in short term, in cash. But then when you're looking medium to long term, you need to diversify your money in a number of different areas. So you need to look at things like geography, the country that the money is invested in, if it's in a fund, a managed fund, the industry, the company, and even the fund manager. So you might decide when we discuss and provide the financial advice, you may see that you want to diversify across 2 different providers, for example, because one will generally be more right than the other over time. So you can split your money across 2 different companies when you look at a managed fund. And asset class then is key. So not to have all of your money, as our granny used to say to us, don't have all your eggs in one basket. And that really is key when it comes to the asset class. So have your money invested across a number of different asset classes, like equities, commercial property, cash, alternatives, renewables. All of these are different asset classes within a managed fund, but it means your money is spread across all of these different areas. And that ultimately is what diversification, it increases your chances of being right, but also then in terms of volatility, when you have diversification, that's also a protection element as well. Then choose carefully. So in terms of choosing, I say choose carefully when it comes to the advice that you're receiving, and also in terms of the provider, as I said, where to put your hard-earned money. So take Cornmarket out of the equation for a moment. Firstly, in relation to the advice, you should be getting your advice based on what's called a fair analysis of the market. So really to consider everything that we've looked at above so that we can, and the financial advisor can provide you with the best advice for your own personal circumstances and your personal retirement financial plan. With any particular fund and managed fund that you are looking to invest in, there's a few different things that you need to be conscious of. The first one is charges. So similar to the AVC that many of you will be familiar with, the funds themselves will have what's called an AMC, an annual management charge. Some will have 100% of your money allocated, others will have less, but generally speaking, you'd have 100% of your money allocated into the fund. But then you need to look at access to your money within the fund. So are there exit penalties? Usually in the first 5 years, there are exit penalties if you wish to take money out. So that's why it's very important, going back to the idea of your short, medium and long-term money, that you have your short to medium-term money structured correctly. But there are funds where there are no exit penalties and you can access your money within 7 to 10 working days if required. But when we sit down with you, we would advise you and structure it the best way to suit your circumstances. And then provider. So as I said, from an advice point of view, you want to ensure you're getting the advice based on what's called a fair analysis of the market. But also the company, as I said, where you're placing your funds, you need to be conscious of how they apply these different areas. And we look after and we work with all the various companies that provide these managed funds. So we can show you the various options across the providers, as you can see here. And that where Cornmarket, in terms of providing financial advice at retirement, we can ensure that you're getting the various options and you can see what's available out on the market. So some companies or advisors that you would talk to, they will just recommend one particular company. The reason being they can only provide advice or give recommendations for that particular company. It's important that you look at all the different options, and we're a multi-agency intermediary, so we can look at all the various options out there for you. It also then is a case, it's not just, as I say, at retirement, but into retirement. You want to ensure that you're getting regular updates and advice. And our investment matrix committee, we look after this for you on an ongoing basis. So we recommend the funds for retiring public and civil servants, but we also then review them on an ongoing basis. If there's any particular updates, we'll communicate this to you and we'll offer you regular reviews to ensure that the monies that you have put aside for your medium to long term in terms of your retirement financial plan is doing what you need it to do for you. And this is unique to Cornmarket. An additional consideration, and particularly as going back to the recent past, these areas we're becoming particularly conscious of. That's environmental, social and governance issues. So the reason being, it's not just putting your money and having your money invested, but it's also where and how that money is invested. So these are additional considerations that we factor in now in terms of environmental considerations, particularly around, for example, climate change, etc. But also you have the social area. So you're looking at, and particularly with the last couple of years we've been through, how companies are working with their employees, with their stakeholders, and focusing on social purpose. And governance then, how companies are actually governed. So there really is a move away from not just how your money or where your money is invested, but how that money is invested for you. And we will look at this on your behalf when we're giving recommendations. Thankfully in Cornmarket, we have a really good working relationship with the majority of the public service and civil service unions and the various employers as well. So that gives you very good support, because not only am I answerable from a regulation point of view to the central bank, but also ultimately to you, but your union as well. And that gives people good security and comfort when it comes to having their money and getting advice on their money at this very important time of life for you. You can see here that a lot of your financial considerations, as I outlined at the beginning, will change. And there's things that you need to be particularly conscious of. The need for life cover. So many of you will be in your union salary protection scheme, which has medical immunity. So you'll be able to continue on with an element of life cover into retirement, which is a fantastic benefit. You need to look at your savings. So it's not just looking at the lump sum, for example, from the pension scheme, but your savings, putting all of that money together and looking at how best to structure that and manage it for the short, the medium and the long term. Inheritance planning, particular consideration, especially with property price increases over the last number of years. So are you going to leave a tax liability that your children would have to pay, or can you avoid that through some inheritance planning in advance? So we'll consider that with you. And then you have all the various insurances, health insurance, travel insurance, which we'll be using now thankfully more and more. So these are considerations for your finances at this stage of life as you look now to this next chapter. So to sum up, put your retirement plan in place. I started with a shannuckle, I'll finish with a shannuckle. Ní heilán na gui heilán na scollab. The day of the big storm is not the day to go tatching. So put your retirement plan in place. Don't lose to inflation. Think long term. So make sure that, yes, you have the short term, but you're also looking to the medium and long term as well. And ultimately meet with one of our experts, someone who will sit, and we will sit with you, look at all of your personal considerations with respect to your finances, your goals and objectives, and help you put your retirement financial plan in place. So thank you, and I hope you have a very happy, healthy and prosperous retirement.
So, welcome back everybody. I know there's been a lot of questions coming in the chat function there. So we've put together some of the kind of more frequently asked questions, and hopefully we'll be able to address these now in this session. So we've had quite a few questions in for the last hour and a bit. So Conor, you might take the first one here. If I'm already doing an AVC, should I do a last minute AVC?
Okay, that's a good question. It's a question we get asked at this time coming up to retirement. So there's a few reasons why you would make AVC payments, but ordinarily, first and foremost, you want to ensure that you have the maximum tax-free lump sum. Okay, so if you have an AVC and you have the money in it to plug any shortfall in the tax-free lump sum, you then need to look at the tax efficiency, as in, the great thing about additional voluntary contributions is the tax relief that you get, but you then need to look at how the tax will be on the far side.
Yeah.
So everyone's circumstances are different, and it's probably a theme you'll hear when it comes to retirement planning. Everyone's circumstances are different.
Yeah, I think the key is kind of maybe to review your situation as you're coming up to retirement.
Exactly.
A lot of people there might not be a need, that's the first thing.
Correct.
But there could be a need as well. So I think it's important just to sit down, look at your AVC, see is it doing exactly what you want to do. Maybe your circumstances have changed.
Yeah.
You might be going a little bit earlier or a little bit later, whatever the case may be. So like you say, we go back to the personal circumstances a lot of the
Correct,
time.
exactly.
Pam, I think this might be for you. How much should I take from my AVC tax-free?
Okay, I knew this question was going to come up. I often get asked this question. So I suppose there's no straight answer really to this, but if you think back to my presentation, the slides that I covered off, so if you think about first and foremost, so the first shortfall is a difference between what you're going to get with full service and what you're going to receive from your employer with the actual service that you have, okay? But then there's other factors that we have to take into consideration. So you may have non-pensionable earnings. Okay. It could be a case that you have the over 40 years of service. So again, kind of as Conor was kind of alluded to a second ago, it's kind of an individual circumstance, I suppose, but what we'll do is we'll calculate it taking all of those factors into consideration, and then we'll come with a figure.
So So you have to look at somebody's final salary, their year service
Absolutely.
are probably the primary ones.
Yeah,
and then
exactly.
after that, the one on the 40-year service and the over 60 is one people are not kind of get caught out on a lot
Exactly,
of the time.
yeah.
What I've kind of found that is that, you know, a primary school teacher might be a good example where you started teaching at maybe 20 years of age and you retired at 65 and you could have 45-year service.
Yeah.
You won't get any extra benefit, and sometimes people get caught up in that. You won't get any extra benefit from your employer, but by using an AVC, you can get more money.
Absolutely.
Exactly. It's as there Pamela said in the presentation. I mean, the best way to think of it is revenue rules supersede superannuation rules.
Yeah.
So whatever your superannuation scenario is, there's a separate set of rules with revenue. And a lot of people, when they're looking at their tax-free lump sum shortfall, it's, as you say, Pamela, it's the revenue rule that gives them an extra bit over and above.
Boost, yeah.
Exactly.
Great, okay. I'm D1. Can you recap on how my pension is calculated, Pamela?
Yeah. Okay, so just, I suppose, look at this. So if you're D1 and there's two pension benefits you're going to get, one is obviously your pension and your lump sum. So to put simply, your pension first of all, so it's going to be 1/80th for every year of service you have by your final salary. Okay, your lump sum is slightly different because it's going to be 3/80ths of your final salary by the number of years you have. So again, if I just use kind of a simple example, let's say you're on a salary of 80,000 and you've got 35 years of service. Well, basically it's going to be 35/80ths of your final salary. So divide by 80, multiply by 35.
So you take your pensionable salary, if you know that, you know your year of service, divide it by 80, multiply it out.
Exactly.
Should give you an approximation.
Exactly.
Won't be 100% exactly, but should give you a pretty close approximation to get an idea. Okay, grand. Does everyone get an old age pension, Conor?
Okay, well actually that question follows on from just what Pamela was outlining there, you know, because really you have the three different PRSI classes. You have your D1 and B1, and then you have your A1. Okay, so really a lot of the change happened in 95, but it's also before that because you've had people, let's say, who weren't necessarily in the pension scheme or they were part-time, etc. So what you need to look at is what PRSI stamp did I pay? Okay, so for a lot of people working in the public and civil service, they have what's called a coordinated pension benefit. So it isn't like the old system of the D years where you get X years over 80 and that's the calculation. It becomes a bit more complex, the calculation. So there's basically you have two providers. You have your employer and you have the Department of Social Protection.
Yep.
So you do need to see, and we'd highly recommend it, and we'll give you the information as to how to do it, but you should be getting a record of your PRSI contributions.
Yeah,
exactly.
Because everyone's circumstance, again, we go back to it, is different.
Exactly, but it's really important to understand that, like sometimes people say, well, you know, a teacher's pension or a nurse's pension or a civil servant's pension is X, Y or Z. You really have to look at, well, what PRSI class did I pay? What pension scheme? When did I start? Like you could have, for example, a few years you worked back in the 1980s and you may have paid the A1 stamp. So
you're buying that back, or
exactly.
I think the key there is if you're D1 and your pension is based all the way along on D1, you won't get an old age pension as such.
Correct.
It's based on the A1 PRSI contribution is what your old age pension is based on.
That's it.
And to get a record.
Correct. And it also then means, like, as we say, you want your appointment in advance of retirement. These are the things that you need to look at and go, right.
It's your list, isn't it?
Exactly. You have all the information so that you can make informed decisions, and that's key.
Okay. Can you help me fill out my retirement form? I think we're referring to the retirement form that you have to fill out when you retire, Pam.
Yeah, so absolutely. So what I'd say to everyone is, like, there's actually a section in that retirement form which specifically relates to the AVCs. So often I would get phone calls saying, Pam, I'm not really sure, can you? So yes, what I would say is absolutely give us a call. We'll help you fill it out. And in particular, the one that throws people a lot is that section that deals with the AVC. What's my value? What am I taking tax-free, so on and so forth. So don't be shy.
It's a declaration as such of what's in your AVC and what your plans are with it.
Yeah, that's
okay,
it.
Right. Okay.
Generally, they're just on that. It's probably 3 months out from retirement. That's generally the time frame when people put in that form.
Yeah, it's good. Like when should you be letting your employer know?
Yeah, that's it, exactly. And it puts obviously then your consultation around that time. If you're chatting to your consultant, they will give you exactly like Pamela outlined there. They'll be able to help you with all of this. And that's the key, really. We want to help people through this process.
Should everyone have an AVC, Conor?
That's a good question. I suppose a little bit like the first question, as in, you know, I have an AVC, should I be putting more into it? The majority of people you'll find should have an AVC because it's tax efficient to make AVC payments.
It probably relates directly maybe to the lump sum, the last minute AVC, I'd say, so that person's maybe asking, you know.
Yeah, well,
So maybe I rephrase it. Should you have a last minute ABC maybe, or a single premium ABC before you retire?
correct. Well, then on that basis, absolutely, you would say if you have a shortfall in your tax-free lump sum, okay, and we will help you calculate that out. If it's affordable to do so, if it's tax efficient to do so, you should be making an ABC payment.
Yeah.
You've paid tax for the last 30, 35 years, PAYE. You have an opportunity there potentially to get some tax back, and it's a limited window because once you've retired, you're retired.
You
You can't
have
do
to
it.
do this again before you
That's
retire.
it, exactly.
I think sometimes I kind of go back and say, like, if the benefits outweighing the cost, then you should do it. If it's not, then you shouldn't. And that's kind of fairly straightforward. It sounds very straightforward, but it's the calculations to work it out then, isn't
That's it, exactly.
Okay. What way are Cornmarket doing their appointments at the moment, Pamela?
Okay, so at the minute, I suppose we've two options. So we have obviously the online, which we've been using, which has been Teams, or we have face-to-face. So I suppose what we found is over the pandemic or through COVID, the online has worked really, really well. So much so that that's nearly the preference at the moment. So most people they still want to do the Microsoft Teams appointments. But that being said, like all people someone who wants a face-to-face appointment, I think it's fair to say that we're not going to have an issue with that. We can obviously go out now and we can do it face-to-face if required.
You know, the way things are moving forward, it's whatever suits people the best, Conor, I'd say. Yeah?
That's it. We've come a long way from our first one or two Zoom calls that we all did at the start of over the last couple of years. But that's it exactly. I mean, as you said, Pamela, there's nearly a preference for it there for many people at the moment.
Depends on what suits people the best.
Exactly, and that's the thing. There's both options are there.
I think this is probably for you, Conor. How has the pandemic affected my investment? It's a good question.
It's a good question. And how long do we have? So look, with the pandemic, you're going to have, and you have had, if you think back to the slide I showed you earlier, where you can see over the long term, generally speaking, economic growth, economic cycles, asset values will increase over time, but you'll have events that happen that affect the value of the assets. So the pandemic did have an effect on markets initially, and it did have an effect on the value of funds, but that's going back now, more than 2 years now at this stage, okay? And they actually responded quite quickly and very well subsequently. And there's been a bit of volatility recently, but you're always going to have volatility with any type of investment, okay, be it a pension or invested fund. So the long term is the key, ultimately. And thankfully, the funds that we recommend and advise have done exactly what we say.
A lot of the ABC funds have default strategies as well to bringing the money back into secure funds as people get closer to retirement.
That's it. That is a key part, as you rightly say, on the ABC investment strategy, is if you're in a strategy, that the closer you get to your retirement age, that it does move across to a secure fund. So in that sense, but look, everyone again, you need to look at your own particular scenario, and we'll advise you and we'll show you, how things have performed for you, and give you all that information in the consultation.
Okay. Just a couple more. How quick after I retire can I get my money, Pamela? I think that's probably referring to somebody settling their age.
Yeah, so again, and I kind of covered off this, I suppose, in my presentation a little bit. So generally speaking, there's kind of a process that we have to follow when you come to retirement. So again, once myself or one of my kind of colleagues, once we meet with you, and there'll be documentation that we'll require at retirement. So remember I said going back to your final superann, your income declaration form, that usually takes about 2 to 3 weeks. And then once we get that option letters generated and we get that back, then you look at maybe a further 2 to 3 weeks. That'd be fair
so after people retire, once we get their superann details, which is their final pension details, we do what's the final options letter, and then so probably say 4 to 6 weeks after you've actually retired is kind of the process you're looking at.
Correct. And it's really the one thing.
To be fair, it depends on how long the employer takes to get the details.
You took the words out of my mouth, Owen. That's the thing. It's the one thing that's out of our control is the employer and them getting that superannuation.
And most are very good, to be fair.
Yeah,
but it is
exactly.
once you have those final details, it's probably 6 to 8 weeks after that you'd have your ABC.
Yeah, that'd be about right.
Yeah, right. Okay. Very close to the end. If my partner is still working, does it affect my ABC drawdown, Pamela?
Okay, so again, this is kind of goes back to what Conor said a moment ago. So it's very individual. So what I would say to people is, first and foremost, if you are retiring, I think it's fair to say you need to be getting tax advice, because there's so much is changing. So it could be a case you're now going from, let's say, a salary down to a pension. But if your spouse is still working, you might be sharing tax credit. You could be giving them some of yours because obviously they're still working, still earning a salary. So they want to obviously get as much as they can on the lower rate. But then if that spouse was, say, in a year or two, then they decide to retire, then it's a scenario where both of you are on a pension as opposed to a salary. So it's a case then that you need to kind of rejig the tax credits, or you need to kind of rejig what's going on behind the scenes.
It's been tax smart at retirement.
Exactly, just being tax smart. So I'd say get the advice, definitely.
Yeah, kind of the two most important tax returns, no joking aside, are kind of when you get married and when you retire, because everything is changing.
Absolutely.
And I think that's the key, isn't it? So
we just see it time and time again where people are just overtaxed because the bands aren't split correct between the spouses.
Okay. Last question, I think, actually. I'm planning on retiring I was initially planning on retiring this year, but now I'm going to stay on for another year or two. Should I let Cornmarket know? Conor, do you want to address that?
Yeah, I'll take that question. I suppose it feeds in a little bit there to the question about investment strategies. So, we spoke about that earlier. So it is important that we know when your intended retirement date is, first and foremost, because many of you are in an investment strategy. So in order to move monies across into the secure funds, we need to know when the retirement date is. So absolutely, we would ask you to tell us when that is, but also from a service point of view, because if you let us know, let's say you might have been planning to retire in 2 years, and we may have that noted, but you might now be deciding to retire this year.
Yeah, exactly.
And
could obviously either way, of course.
Correct, that's it, exactly. So I suppose simple answer is yes. If you are changing your retirement date, we would ask that you contact us, and we'll work ahead from that then.
Okay, folks, that's great. That's kind of bringing us up to the end of the questions. I know there was a lot more questions, but a lot of those were addressed in the chat function. Yep. So I think that's where we are. So thank you for your time.
Hi, Brent Pope here. I know you're not going to believe it, but I turned 60 this year, and I know what you're all thinking. He doesn't look a day over 40. But I suppose COVID lockdown gave me a lot more time to think about retirement and think about what retirement might look like for me. For all of us, retirement or retiring is a huge life event. And in many ways, it can often leave us feeling like we've somehow lost our identity. But just remember, it's actually in our DNA to resist change. The human mind doesn't like change. So the sooner we can prepare mentally for a new life in retirement, the better it will be. So don't expect to retire from work on, say, a Friday and think that everything will be the same the following Monday. It won't. A lot has changed. Of course, that doesn't mean it's not going to be a great experience. Just make sure that you're prepared that it's going to feel a lot different for a while. So here are my 5 top tips for mental well-being in retirement. Popey's tip number 1, prepare for retirement well in advance. Maybe 5 years before, like me. So get used to more flexible working hours and conditions. And in that regard, COVID may actually be a good thing for you because it's given you a head start on how to use that experience. It's allowed us to practice what retirement might feel like. More time at home, more time doing things you want to do, more time with hobbies. Number 2, plan what you are going to do with all your free time. Replace your old work routines with new routines. Plan each day and make a list of the things you want to achieve, rather than just do. What do I mean by that? Rather than just reading a book, why not write your own book, your own memoirs? Rather than just taking up golf, why not aim to win the captain's prize or lower your handicap at the end of the year? Small achievements each day all add up to a sense of self-worth. Try to stay somewhat task-driven. Number 3, vital, create a new group of friends. As we get older, our social circle seems to get smaller. So pursue new interests, sports and hobbies, and with it will come new and exciting friendships or relationships if that's what you're looking for. Don't forget at the same time to work on your existing friendships from work and so forth, with regular contacts and meetups and phone calls. And men, this applies to us because we're notoriously bad at staying in touch. Number 4, step out of your technology comfort zone. Technology is not just for the young ones. There's a whole new and exciting world of communication out there, from the latest apps to making life easier by paying their bills online. It's a great way to stay in touch too with friends and family that may have moved abroad. Maybe take an evening course on technology and learn. Number 5, take some time to get to know yourself again. Your work and your personal life has possibly defined you and has become part of your identity, especially if you're a teacher or a similar type profession. Ask things like, what is your new purpose in life? If it's to educate, then find a way to educate. If it's to give back to community or society, take up charity work. But continually ask yourself what it is that will make you feel happy in the last third of your life. What we value in life at age 20 is not what we value at 65. Learn to be a positive thinker. Smile. You've worked hard and you've made it this far. Some don't. Be grateful and embrace every day. And as the song says, don't worry, be happy.
Thanks a million, Brent. It falls on me to close our webinar this evening. Thank you for taking your time to join us this evening, and I hope you found the presentations beneficial. We will send you a recording of today's webinar and a copy of the slides used. We will also send you our contact details so you can book your free retirement planning appointment, if you haven't already done so. From everyone at Cornmarket, I'd just like to wish you a very happy and healthy retirement.